Welcome to the deep dive. So you've probably seen the headlines flying around. Moody's downgraded U.S. government debt.
That's right. From the top AAA rating down to AA1, which is, well, basically AA plus 1.
Exactly. And look, the immediate reaction, I think, for many might be, oh no, is this bad for the U.S. Treasury market?
Yeah, definitely some alarm bells probably went off.
Right. So our mission today is really to kind of cut through some of that initial noise. We want to take a more data-driven look, a more maybe sober perspective on why Moody's did this, and importantly, what it actually means.
And we're drawing heavily on some great analysis here from Alf at Palinuro Capital.
Good stuff. Okay, let's get into it then. What was the official reason Moody's gave for this downgrade?
Well, they stated it pretty clearly. They said it reflects their view that basically successive U.S. administrations and Congress haven't managed to agree on ways to, reverse the trend of big annual deficits and the rising cost of interest payments.
Right. And I think the mainstream takeaway you heard was, concerns about the U.S. maybe not being able to pay its debts. And this huge number, over $1 trillion a year, just in interest now.
Yeah, that figure definitely grabs headlines. It sounds pretty worrying on the surface.
It does.
But this is where Alf's analysis offers a really different and I think crucial perspective. It comes down to understanding how the U.S. monetary system actually, well, works.
Okay, I'm interested. Let's dive into that alternative view. What's the key thing to grasp about a government like the U.S. that issues its own currency when it comes to deficits and bonds?
The fundamental point, really, is that for a government that controls its own currency, running deficits isn't automatically a path to ruin. It's actually a primary mechanism for the government to inject money, purchasing power, into the private sector.
Inject money. How so?
Well, when the government spends more than it taxes, that difference, the deficit, effectively increases the net financial wealth of people and companies. Think more money ending up in bank accounts.
Ah, okay. So it's really not the same as, like, me or you running a credit card debt.
Not really, no. It's a very different dynamic. The government doesn't have to repay this debt in the same way a household does. In fact, trying too hard to eliminate the debt through, say, big budget surpluses could actually hurt the private sector, right? Through higher taxes or maybe spending cuts.
That flips the usual narrative quite a bit.
Yeah.
How does the mechanics of that work, getting the money into the private sector? The source mentioned T accounts.
Yeah, let's simplify it. Think of it maybe in two steps. First, the government builds a bridge, sends out checks, whatever. That money lands in bank accounts, increasing deposits. So private sector net worth goes up. Banks end up holding more reserves at the central bank.
Okay, step one.
Then step two, the Treasury issues bonds to sort of match that deficit spending. Banks, pension funds, investors, they buy these bonds at auctions. They're essentially swapping those reserves they got in step one for these interest-bearing Treasury bonds.
So the bonds are kind of like a savings account for the reserves created by the deficit spending.
That's one way to think about it, yeah. So when you hear about these huge levels of national debt, the analysis argues that framing it purely as a burden can be misleading. It's also the flip side of financial assets held by the private sector. Alf even calls the worry about the level of debt itself, quote, groundless.
Groundless worry. Wow, okay. That's a strong statement.
It is, but it stems from that understanding of the monetary plumbing.
Okay, let's circle back to the interest cost then. Over $1 trillion annually. That still feels like a huge amount of money flowing out.
It's definitely a large number, no doubt about it. But again, we need to see both sides of the transaction. For every single dollar the U.S. government pays out in interest, someone somewhere is receiving that dollar as income. It could be a pension fund managing retirements, an insurance company, maybe even you through your savings or investments, or another country holding treasuries. It's risk-free income for the bondholder.
Right. It's not just disappearing into a black hole. It's an income stream for someone else.
Precisely. And crucially, the government's finances aren't like a household budget where you have to choose, do I pay my mortgage interest or buy groceries?
So not choosing between interest payments and, say, healthcare spending.
Not in the same direct trade-off way. The real constraints on government spending are different.
Okay. So if the debt level itself isn't the main worry and the interest payments have another side, what are the actual limits then? When does running big deficits become a problem?
The analysis points to two main things. Inflation and the real resources available in the economy, like workers, materials, energy.
Yeah.
If the government pumps too much money into the economy when it's already running hot, or when there are bottlenecks like we saw in 2021, 2022.
Right, the supply chain issue.
Exactly. Then you get too much money chasing too few goods and services, and that pushes prices up. That's inflation. That's the real constraint.
That makes sense. Okay, so let's bring this back to the Moody's downgrade itself. The practical change is U.S. debt is now rated AA+ instead of AAA. What does that actually mean day to day for investors, for markets?
Well, the analysis really emphasizes the unique role U.S. Treasuries play globally. They're not just any bond, they're like the ultimate collateral.
Because they're seen as super safe.
Super safe, yes, but also incredibly liquid, easy to buy and sell huge amounts. Plus, there's a massive repo market built around them and, a stable legal framework. That top-tier rating was part of that package.
So the big question is, does dropping one notch to 8A+ actually break that?
Let's look at banks first. They're huge holders and users of treasuries.
Right, they hold them for liquidity, right? HQLA.
Exactly. High-quality liquid assets. Banks need these to meet regulations, ensuring they can cover outflows in a crisis. They also use them as collateral in trades and sometimes to hedge interest rate risk.
Okay, so how does the downgrade affect that?
Here's the key thing. Under the international Basel regulatory rules, the standard approach gives government bonds rated anywhere from AAA down to a 0% risk weighting.
0%.
Meaning banks don't have to hold any extra capital against them because AA+ is still comfortably within that AAA to AA bracket. The downgrade makes, well, basically no difference for banks using that standard approach.
What about banks using their own internal models, the IRB approach?
Good question. Even there, most regulators allow a 0% risk weight for investment-grade bonds issued by their own government, and AA+ is firmly investment grade.
So for banks, from a regulatory capital perspective, this is kind of a non-event.
Pretty much, yes.
Yeah.
The analysis concludes it has no practical effect there.
Okay, that's significant. What about the repo market? You mentioned treasuries are used heavily as collateral there.
Yeah, hugely important market for short-term funding. Think about, say, a pension fund. They might have spare cash they want to lend out very safely overnight. They can do a reverse repo, lend the cash to a bank or dealer, and take treasuries as collateral. Super safe way to park cash.
And the rating affects the value of that collateral.
It can affect the haircut, basically, how much the collateral is discounted for safety. But again, the Basel Committee guidelines put bonds rated AAA all the way down to AA in the same top category, requiring minimal haircuts.
So, same story. AA+ doesn't change the calculation.
Exactly. The downgrade doesn't really impact how treasuries function as prime collateral in these crucial global funding markets.
Okay. So despite the headline, the actual plumbing of the financial system doesn't seem immediately affected. The analysis also mentioned we shouldn't directly compare this to the S&P downgrade back in 2011. Why not?
Right. It suggests a direct comparison makes no sense. While it doesn't dive super deep into why in this specific piece, generally you'd consider things like the different economic backdrop then versus now. Maybe the specific reasons S&P cited were different, market sentiment was different.
Just too many variables to do a simple apples to apples.
Probably, yeah. Context matters a lot.
Okay. Now, thinking about bond yields, like the 10-year Treasury yield, how might a downgrade influence that? The source breaks yields down, right?
It does. It typically looks at three components. The real yield, compensation for lending after inflation, expected inflation over the bond's life, and then something called the term premium.
Term premium.
Remind me. That's the extra bit of yield investors demand for the risks of holding a longer-term bond compared to just rolling over short-term ones. Risks like uncertainty about future growth or inflation volatility.
Got it. So where does the credit rating fit in?
The argument is that a rating change itself primarily affects that term premium component.
Okay.
But because, as we've discussed, this specific downgrade doesn't seem to fundamentally change the role or usability of treasuries in the system.
The impact on the term premium shouldn't be massive.
Exactly. The analysis suggests a big negative market reaction, like a sort of self-fulfilling fire sale just because of the rating change. It's pretty unlikely.
Okay. But Moody's did raise that point about the deficits being persistent, right? That seems like the valid underlying concern they flagged.
Absolutely. And the analysis agrees that this is a key point. Running primary deficits before interest costs of 3% of GDP or more year after year and seeing them grow, That does require a different lens for looking at bond markets compared to, say, the 2012-2019 period when deficits were generally smaller.
How so? What's the implication of those bigger persistent deficits?
Well, first, that consistent fiscal stimulus tends to boost underlying economic growth or at least limit weakness. It puts a floor under things, maybe.
Okay, keeps demand higher than it otherwise would be.
Right. And second, it likely contributes to inflation being stickier, harder to get down because you constantly have that extra government spending adding to demand.
And that feeds into expectations about interest rates, I guess.
Mm-hmm.
The source mentions the neutral rate.
Exactly. The neutral rate is that theoretical interest rate where the economy is sort of in balance, not booming, not contracting. The Fed currently thinks the neutral nominal rate is around 3%.
But the argument is these big deficits might be pushing it higher.
That's the idea. Persistent fiscal injections, plus the fact that households and businesses in the U.S. have actually reduced their debt levels overall, deleveraged, that combination might mean the economy can handle or even needs a higher neutral rate than in the past, maybe higher than 3%.
Interesting. And is the bond market reflecting that view?
It seems to be. The analysis points out that the bond market is currently pricing in a neutral rate closer to 3.50%.
Okay.
And also look at the yield curve. The difference between, say, 10-year and 30-year yields is relatively steep right now. That suggests investors are demanding that extra term premium we talked about, likely as compensation for the uncertainties linked to those deficits and future inflation.
So putting it all together, the market seems to be digesting these deficit concerns already, and bonds are maybe fairly priced given the situation.
That seems to be the assessment, yes, that current bond yields reflect these dynamics reasonably well.
And the expert even suggested potentially buying longer-term bonds if yields climb a bit more.
Yeah, Alf mentions considering adding to 30-year Treasury positions if the yield gets above 5.25%. The implication is that at those levels, the compensation for the long-term risks becomes quite attractive.
Okay, wow. We've covered a lot of ground there, from monetary mechanics to market pricing. Let's try and summarize. What's the main takeaway for listeners from this deep dive into the Moody's downgrade?
I think the biggest takeaway is that while the downgrade definitely made waves and got headlines, its immediate practical impact on how the financial system works, and especially on the core role of US Treasuries as, the global safe asset, seems pretty limited.
Right. It really highlights how crucial it is to look under the hood, beyond the weighting itself, and understand the monetary plumbing, as you called it.
Absolutely. You need that context to interpret these events properly.
But that being said, the underlying issue Moody's pointed to, those persistent large deficits, that's still relevant.
Oh, definitely. Well, the downgrade might not be the main event. The reason for the downgrade, the long-term fiscal path and its potential impact on inflation and where interest rates ultimately settle, that's certainly something worth keeping a close eye on.
Okay, so maybe here's a final thought for you, the listener, to chew on. If we do see these kinds of large government deficits continue year after year, how might that really start to shift long-term expectations about inflation? And what could that mean not just for government bonds, but for all sorts of other investments in your portfolio? Something to think about. Thanks for taking this deep dive with us.